The US stock market tumbled yesterday due to mixed conflicting signals or outcome arising from the US-Iran war that has already entered more than the 25th or 26th day, as both sides are not showing signs of backing down, despite the claim from US President Trump stated that negotiation process are in good faith. But however, markets choose to ignore Trump's optimism and see a risk-off scenario in the global financial market yesterday, where the major US stock market tumbled, gold prices tumbled as well, and where you see West Texas crude oil rising above 93.70, and as well as the US dollar index rose for the third consecutive session. In today's Asia session, there was actually a pullback in the US dollar strength, reinforced by some hawkish speech from ECB officials that allowed the euro to find some form of stabilization at our minor expanding wedge support level, which we highlighted earlier in my daily dose. And that particular so-called hawkish guidance by several ECB officials yesterday, indicating that next month, April, there could be a live event for an interest rate hike coming up from ECB. All right, welcome back to today's Daily Dose of Market Insights. I'm Kelvin here. Today will be Friday, the 27th of March, 2026. So before we kickstart the gist of today's Daily Dose, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. Right, so here we go. Okay, so let me make sure that the screen is good. Okay, so let's kickstart what has taken shape yesterday in terms of the news flow and relevant economic data / events. So let me start with yesterday's conflicting, we call it condition arising up from this US-Iran war / conflict. So let me share my screen. All right, so over here, as of Thursday, right, so what President Trump did is that he actually escalate this, what you call it, threatens escalation with both sides at odds of this ongoing peace talk. So yesterday, US President Trump threatened Iran with intensified military action, and he said he's unsure whether a diplomatic agreement can be reached. All right, so why does he has such a hawkish rhetoric? Because Iran has rejected a US ceasefire proposal, which Trump claimed that he has sent a 15-point proposal to an Iranian leader that his diplomat has been negotiating without naming who is the Iranian leader, and that actually created a risk-on push up at the in the European at the end of Monday, during US session on this Monday, and that risk on behavior turned out as market doesn't see any progress about this so-called ceasefire negotiation talks or proposal, and is waiting for a response to its rejection of a US 15-point plan to end the war. So actually, Iran has really rejected the plan, and it has its own condition of a ceasefire, their own condition, the 5-point condition. And yet, early Asia session at around 4:15 a.m. as usual, so Trump decided to extend its US energy attack pause and claims that Iran talks are ongoing over here. All right, so still recall that on earlier the previous weekend, means on Saturday, he actually threatened to attack Iranians energy / gas infrastructure, choking off of gas supply for the Iranian economy, hoping the Iranian economy will crumble down. And he decided to put a pause to this attack. Previously was a 5-day deadline, so he extended this deadline by 10 days over here. So if you look at 10 days over here, it will be on next Monday, 6th of April 2026 at 8 p.m. So appears to me that there's a lot of drama going on. So even though he claimed, US President Trump claimed that this whatever Iranian/US negotiation talks are ongoing, where he extend this energy attack pause on Iranian's gas/oil infrastructure. At the meantime, the Pentagon is considering sending more troops to the Middle East, with the Wall Street Journal reporting that the Defense Department was considering sending as many as 10,000 troops. So at the which I highlighted at the start of this week daily dose, 2,000 troops already enrolled to Middle East. So right now, based on this Wall Street Journal, more troops are actually amassing around the Middle Eastern region. So what market view over here, that it seems that US President Trump is using this so-called successful negotiation process that he claimed that is ongoing for excuse to actually give more time for a ground invasion that unfortunately may take place in the Iran next week. So market participants are not buying this taco team play. Why is taco? Trump always chicken out playbook again, like what he did during last April global reciprocal tariff exposed Liberation Day, where he kind of engaged a pause on the implementation of global reciprocal tariff, and we see a very vicious multi-month V-shaped recovery in the global stock market. But that is not taking place right now. How do I view that? If you look at the current S&P E-mini futures is positive, but it's not gaining that much strength yet. All right. So right now, if you look at the E-mini futures, they're only up marginally by positive 0.3% on the S&P E-mini futures. Similar for the Nasdaq E-mini futures as well, up only positively 0.3%. And if you look at yesterday's slew of negative performance in the US hour trading session of the S&P 500, by the end of yesterday's US trading session, that means end of Thursday session, all four of them closed deeply in the red. The SPX down by negative 1.74%, the Nasdaq down by negative 2.4%, and the Dow Jones Industrial Average down by negative 1%, the Russell down by negative 1.7%. And if you were to look at the way they react, earlier this week, risk on behavior, they actually try to test the 200-day moving average on the three major US stock indices, which is the S&P, the Nasdaq 100, and the Dow Jones, but they shape a bearish reaction of its 200-day moving average, evidenced by yesterday's movement, where they come up with almost a bearish candlestick rejection of the 200-day moving average. So what you could see, this will be the Dow Jones Industrial Average. Earlier on, there's this whatever we call it, the dead cat bounce, the relief rally, where Trump's decided to actually put a pause of his earlier threat of attacking Iranian's oil and gas infrastructure/asset, and he also claimed that there's some form of negotiation process that's being kickstarted between the two stakeholders. Market rallied, but yesterday's we call it mixed signal or mixed condition coming up from both stakeholders sent the Dow Jones Industrial Average a bearish reaction of its 200-day moving average. So highlighting the fact that whatever rebound that we've seen on this Monday is more like a dead cat bounce. So this is the Dow Jones Industrial Average. Similar price action also can be seen on the S&P 500 over here. So the S&P 500 is much more worse. So if you look at where it closed, it actually closed below the close of last Friday. All right, and right now it's just marginally holding on to last Friday low, right over here. Okay, this bearish Marabuzu candlestick, a bearish reaction after the relief rally failed to make any headway at the key 200-day moving average. Nasdaq 100. Okay, very similar as well. And the Nasdaq 100 is the weakest because it's clearly broke below last Friday close and also broke below last Friday low. all right, over here. So indicating that there is no clear signs of that taco team play, that market participants now has choose not to believe it again, okay, over here, and send the US stock market lower. The Russell 2000. So the Russell 2000 also staged that bearish reaction, but so far the Russell 2000 is the only one that is managed to hold that 200-day moving average. But do not forget, the Russell 2000 is not a leading major US stock indices. So the leading major US stock indices, which is the S&P, the Nasdaq 100, and the Dow Jones, all three of them, those are the bigger products. So the bigger products has already broken below its 200-day moving average very clearly and did a bearish reaction of them. And yesterday's price action sent them lower below last Friday close, and the Nasdaq 100 broke below last Friday low. So that potentially indicate that the Russell 2000 may follow suit as well. So all these four price action of the major US stock indices doesn't indicate a taco bullish reversal play at this juncture. All right, so this is something I'd like to share with you guys over here. And if you were to go to the 5-day rolling performance of the US dollar against other major currency, so the dollar continues to rise over here based on the 5-day rolling performance. But if you look at from a macro minor time frame perspective on the last 24 hours by looking at the 1-day rolling performance. So if you switch the 1-day rolling performance over here, we see something like a bit of a K-shaped movement where the dollar is strengthening against the Swiss franc. But however, the dollar is now weakening against the Aussie, against the Kiwi, and in some form also against the euro and the sterling. So what we could see over here is that there's a bit of dollar strength profit taking into play. Okay, one of the reasons why is because market participants in the very short term is also looking at some technical levels on various key instruments to actually adjust their position. And do not forget over here is that we also have weekend risk taking shape in the next coming up 48 hours or so, as we right now head to the end of the week. So what do you mean by technical level is by looking at the dollar index. So if you look at the dollar index over here, initially we have 3 days of consecutive rallies since Tuesday, Wednesday, and yesterday, finding support at this 20-day moving average, and also the medium-term ascending trend line support that has been in place since 26th of January. So this is currently the current year-to-date low. And right now, the dollar index is now approaching the key medium-term resistance zone of 100.10 and 100.54, which has been in play since 29th of May last year, as the US dollar index continues to be trapped in this complex sideways range configuration. So market participants are pretty much, the bulls are pretty much cautious right now as the dollar index reaching this key medium-term range business level, and coupled with yesterday's various ECB officials' hawkish speeches stating that the April meeting may see ECB kickstarting a interest rate hike cycle. So yesterday, ECB official Nigel said that the April rate hike an option. All right, so indicating that ECB thinking right now is much more of a preemptive rise in inflationary trend that may take hold in the Eurozone due to rising energy prices. And ECB itself is a much more of an inflation fighting central bank rather than a growth oriented central bank. So any sign of inflation spiking up, they tend to actually react much faster compared to the Fed. So based on these various ECB hawkish official public remarks, market participant and also based on ECB Nigel remarks saying that the rate hike could be an option in the April meeting, that also causes the US dollar strength that was seen in the last 3 sessions to see a bit of pullback in today's early Asia session as we are speaking right now over here at 11:21 a.m. Singapore time. All right, and the next thing I want to share with you guys over here is that if we were to look at this slew of remarks so far done by the US key stakeholder. Market is still the key stakeholder between the US, that means the US White House administration, especially Trump's conflicting way of portraying this ongoing US-Iran war/conflict. The Fed funds futures traders continues to price in a pretty much lesser and lesser dovish Fed going forward. So if you look at the CME Fed Watch tool, which they do a compilation of the various month Fed funds futures contract. So Fed funds futures traders continues to look at potentially no interest rate hike that may take shape this year. So what's interesting over here is that if you were to look at the current interest rate, Fed funds rate will be at 3.5% to 3.75%. So if you move down the calendar, coming to October this year, which is the October the 28th FOMC meeting this year, 2026, right now there's an increased chance of a 56% chance that the Fed may hike interest rate by 25 basis points to bring up to 3.75% to 4% over here. And this slightly 50% chance is pretty much being priced in right now across the other meeting since from October. That means that also starts to come in the last meeting of the year, 9th of December the 9th, 2026 at 53%. So previously, before I go for a medical appointment yesterday, which we do have the daily dose, this odds here was around only 30%. So now it's jumped close to slightly above 50%, 56 to 53. So market pricing right now seems to be looking for a potential interest rate hike with increasing odds in the last 3 months of this year. And what's interesting, if you go down the calendar, the market is only looking for the interest rate cut to continue only on the last meeting of 2027, which is the December the 8th, 2027 meeting, where we have a 95% chance that the Fed may do a 25 basis point cut to bring it down to 3.25% to 3.5%. So what we could see over here is that the Fed funds futures traders are increasingly pricing out interest rate cut this year, and in fact, having a higher odds of an interest rate hike due to this stagflation risk that is rising in the US economy. So with that, that potentially also doesn't gel down to a risk-on environment that is that in the stock market because of the lack of liquidity. All right, over here. And right now, let's take a look at the very interesting thing that is all surrounding what is going on in the US-Iran conflict, which eventually created this stagflation fear due to the blockage of the Strait of Hormuz, where close to 20% global oil flows need to flow from there. All right, so the only way to look at it over here is that what market participants in the prediction market view in this current slew of related information that is being bombarded to us in the last 24 hours. So let me share with you this particular screen. I enlarge it. So this is micro, where they did a compilation using live data from poly market, right? So whatever data you see is a poly market. So these lines here are actually resolution or based on the bets that is being placed on the prediction market platform poly market on what is the market participants over there viewing, would there be a potential ceasefire timing odds? All right, so they have 1, 2, 3, 4, 5 timing odds by December 31st, by June 30th, by May 31st, by April 30th, and by March 31st. So we know that next week we come in the end of March. So based on the latest price data right now as we are speaking, the by March 31st ceasefire timing odds is only 5.5%, and it has been reduced. And if you look at the next one, will be by April 30th in red. So that betting odds itself also doesn't look like it's heading towards 50% as well. It's more flattish right now at 45.5%. And the one that is showing higher chances that there could be a ceasefire taking shape will be by May 31st, 56.5%, which is in orange, and by June the 30th, which is in light green, above 50%, which is at 63.5. So prediction market from the bettors in poly market is looking at the ceasefire may only come in with higher probability around May and June period rather than in April. So that also potentially states that whatever medium-term bullish reversal in risk-on behavior may not come at this juncture yet over here. So going forward in the very near term, there could be much more risk-off behavior taking shape in the marketplace. That means, i.e., we may see the dollar holding firm, oil holding firm, gold continues to remain weak because of stagflation fear, and together with that, the global stock market may also trade on the weaker footing based on the very near-term time horizon over here. All right. So with that, that sum up today's daily dose of the first segment of the daily dose. Let me now move on to the second segment, which is the intraday technical outlook segment over here. So with that, let me expand my screen. All right. Okay, good. So let's start with the FX market. Okay, starting with the euro dollar. So before that, let me expand this screen as well. So hopefully the screen is good. All right. Okay, good. The screen can be seen. So let us now start with the euro dollar. So the euro dollar since last the previous Friday, 13th of March low, it has been trading in this minor expanding wedge configuration, and couple of days back, we do have a bearish bias looking for it to float down back towards the bottom of this expanding wedge range configuration, which indeed it hit at 115.20 / 114.95. So that is the support level that we are watching in our Tuesday and Wednesday daily dose of market insights view. All right. So given that this support level has already been reached over here, and right now we start to see a turning up of this RSI after hitting the oversold level. So right now there could be a minor bounce back up towards the top of the range again. All right. So with that, for today intraday bias. So bear in mind that this is not a very strong rebound. It's just a minor bounce off from a minor expanding wedge range configuration. And the movement doesn't seem to be a very bullish, impulsive upmove sequence. It's more like a bounce within this minor expanding wedge configuration. So with that, using 114.95 as my short-term pivotal support level, like I mentioned again, this is not a strong bullish impulsive bounce. It's more like a bounce within a minor corrective expanding wedge configuration, bouncing up towards the upper limit before another sell-off takes shape potentially. So since that is now at the lower limit, from a risk management perspective, it doesn't boils well to have a bearish bias today. So for the euro dollar, I will flip to a mild bullish bias on the intraday basis using 114.95 as my short-term pivotal support. Two resistance level to watch will be 115.73 that was taken down yesterday, and also confluencing with the downward sloping 20-day moving average, breaking above 115.73, 115.73, pardon me, may see a retest towards this Tuesday and this Wednesday minor swing high area at 116.35. A bearish breakdown below 114.95 will invalidate today's mild rebound scenario within this expanding wedge configuration and stage a bearish breakdown to expose the near-term support level in first step at 114.55, followed by the psychological level of 114 figure. That's for the euro dollar. Next up will be the sterling pound, the sterling against the dollar. So the sterling pound also float down as expected, now coming very close to our support level that we highlighted earlier on, and it's going to trap within this sideways range configuration as well, as it continues to still remains above a minor ascending trend line of this sideways range configuration that has been in place since 13th of March. So using 132.60 short-term pivotal support level, flip to a mild bullish bias as well on the sterling dollar for it to bounce back up towards the top of this minor range. First resistance level to watch will be 135.70, which was yesterday's minor support broken down, now turns into a near-term resistance level, and also confluence with the 20-day moving average, acting as a near-term resistance level, similarly at 135.70. Above 135.70, we'll see a retest on this range resistance level that has been in place since 20th of March, which is at 134.50. Only breaking down below 132.60 will invalidate this bounce scenario within its range configuration for the sterling dollar to expose the next near-term support level at 132.20, 131.80, 131.80 in the first step. So that's for the sterling dollar. Next up will be the Australia dollar over here. Let me expand it. Right, heading to the Aussie dollar. So the Aussie dollar drift down as expected over here, almost hitting our support level at 68.38 over here. But what's interesting over here is that we now start to see a bullish divergence on the hourly RSI. So with this bullish divergence on the hourly RSI, there could be some form of consolidation taking place in the Aussie dollar as well. And bear in mind that the Aussie dollar also has a strong correlation with other major US dollar pair. That means if we start to see strength, potential bounce in the euro, potential bounce in the sterling, the Aussie dollar may see the downside movement getting muted today. So with that, we will flip to a neutrality stance. So neutral between yesterday's so-called broken down medium-term pivotal support, where if we tested it during 3 a.m. Singapore time today, and 68.65. So this will range 69.10 / 69.30. 69.30, and the lower limit will be 68.65, which is the 1.236 Fibo extension of this ongoing corrective decline since the high of 11th of March. All right, so flipping to a neutrality stance today for the Aussie dollar, neutral between 69.10 / 69.30, upper limit, lower limit will be 68.65. All right, so that's for the Aussie dollar. Only breaking above 69.10, potentially see a mean reversion rebound scenario to retest 69.55, maximum the 70-figure psychological level. We also confluence with the 50-day moving average acting as a similar support, a similar resistance level as well, pardon me. All right, so that's for the Aussie dollar. Next up will be the dollar yen. So the dollar yen continues to drift upwards over here. So right now, the dollar yen also broke above this former minor ascending, former symmetrical triangle range resistance. Previously, it was a symmetrical triangle range resistance that has been kept since 19th of March. And yesterday, it did a bullish breakout of it over here and did a retest on the yesterday European session. In today's Asia session, there was a sell-off, but this sell-off managed to find support again at this gray line over here. And what's interesting is that the hourly RSI continues to remain above this parallel ascending trend line support. Over here as well. So with that, I will still maintain my bullish bias, but do cautious over here in terms of position sizing. Why? Because it's fast approaching a intervention zone where there could be an increasing risk of FX intervention by Japanese authorities to sell the dollar and buy back the yen potentially. So that range, that level will be at 160.23, 160.74, where in the past FX intervention took place 2 years ago. All right, so using a tightened short-term pivotal support level for today in terms of better risk-reward ratio will be at 15907, former minor swing high area of 25th of March and 25th of March over here. Now turns into a pullback support and very close to this gray line here as well, which is the former minor symmetrical triangle resistance, now turns into a pullback support level. Only a bearish breakdown below 15907 will invalidate today's bullish bias view towards the key intervention risk zone level, which is 160.23, 160.74. You will see it floating down to retest the 20-day moving average at 158.42, 158 figure level. Only breaking below 158 figure level will see a deeper minor corrective pullback towards 15750, 15740, and even 156.55, which correspond with the 50-day moving average. I think as a similar support at 156.55. All right, so that sum up the intraday technical outlook on the 4 major FX crosses. So let us now touch on the major stock indices. All right, starting with the Hong Kong 33. So the Hong Kong 33 managed to bounce back up from the former long-term pivotal support that it tries to do a bit of whipsaw since Tuesday over here at 24,765. So no change in terms of the levels over here. So pivotal resistance still remains the same at 25,187. 25,380 on Wednesday that we highlighted. So still maintaining that bearish bias for the Hong Kong 33 that's representing the Hang Seng Index. Breaking below 24,765 may expose this Monday minor swing low level at 24,257. Only a bullish breakout above 25,380 will invalidate today's bearish bias view to see a further squeeze up towards the 200-day moving average, and as well as this ongoing descending channel upper boundary, which is the resistance level as well, that has been in play since 29th of January 2026 high. So that will confluence with a resistance zone at 25,650, 25,800. All right, so that's for the Hong Kong 33. Next up will be the Japan 225 that is representing the Nikkei 225. So the Japan 225 also now in the Asia session managed to bounce over here. So no change in terms of the pivotal resistance that we have on Wednesday, which is at 54,355. So still looking at 54,355 as my pivotal resistance to maintain this bearish bias on the Japan 225 over here at this 54,355, also confluence with this 20-day moving average. First support level to watch will be this week, this Tuesday minor swing low, where it staged that relief bounce so far at 51,900, and yesterday US session almost come close to it, which is at 52,619. So breaking below 51,900 may increase the bearish bias momentum to retest this Monday swing low area, and also the 0.618 Fibo extension of this ongoing corrective decline since its current all-time high of 26th of February, which will be at 50,630, 50,160. Only a bullish breakout above 54,355 will invalidate today's bearish bias view to see a squeeze up towards the 50-day moving average that also confluence with the swing high area of 11 of March and 18 of March at 55,135. Breaking above 55,135 will see a much more pronounced mean reversion rebound heading up towards 57,460. So that's for the Japan 225. Next will be the Germany 30 that's representing German DAX. So the Germany 30 continues to have that bearish reaction yesterday below our Wednesday pivotal resistance that we highlighted, 23,280. So no change in terms of the levels because yesterday push down hasn't broken below our first support level yet at 22,430. So these two levels still remains key for today's bearish bias view. So as long as 23,280 short-term pivotal resistance is not surpassed, maintain that bearish bias view on the Germany 30 that's representing the German DAX. Breaking below 22,430 will increase the bearish bias momentum to retest this Monday swing low in first step at 21,930, 21,830. Only a bullish breakout above 23,280 potentially will see a mean reversion rebound unfolding to revisit last Wednesday minor swing high at 23,930, 24,300, which confluence with the 200-day moving average and the 50-day moving average area as well. All right, so that's for the Germany 30. Next up will be the US indices, starting with the US Wall Street 30 that's representing the representing the Dow Jones Industrial Average. So the US Wall Street 30 did that bearish reaction as expected at the 200-day moving average, hitting our first support level before bouncing up after Trump's we call it remark in early today's Asia session at 4:15 a.m. Singapore time, stating that he has decided to extend that whatever ceasefire energy attack, ceasefire Iran attack, ceasefire attack on Iranian's energy gas infrastructure by 10 days over here, and claim that the negotiation process between US and Iran are apparently very smooth right now, but market participants is not showing any sign of a very deep bounce. So potentially it may going to trap within this range over here in today's US session as we head into the weekend, awaiting much more for some kind of clarity from Trump's claim. So as long as this pivotal resistance holds, we still have a bearish bias view on the US Wall Street 30, 46,710. For sure, breaking below 45,940 will open up scope for much more intraday bearish momentum to unfold to retest this Monday swing low in first instance at 45,237, 45,190. Only a bullish breakout above 46,710 will unleash a mean reversion rebound towards 44,338, above 47,338, pardon me, above 47,338 may seek out 47,923 next, which correspond with this descending trend, medium-term descending trend line resistance that has been in place since the current all-time high of 11th of February this year. All right, so that's for the US Wall Street 30. Next up will be the S&P 500. So the S&P 500 also drift down, almost hitting our first support level at 6,470, 6,442. So it printed a low of 6,480 by the time when US session closed, before staging that bounce up from Trump's optimistic remark over here. So that rebound failed to actually break above 6,550, which was this former minor swing low of Tuesday, now turns into a pullback resistance level. So given that it hasn't broken below 6,442, I do not want to tighten my pivotal resistance to 6,550. So pivotal resistance still remains the same as of Wednesday, 6,648, which is the critical 200-day moving average, and as well as the upper limit of this ongoing descending channel resistance that has been in place since 26th of February high over here. So still maintain that bearish buyer's view using pivotal resistance 6,648. First support level to watch will be at 6,470, 6,402. Breaking below 6,442 exposes 6,420 and 6,360 next. So 6,360, if you go back, is a FIBO extension level, 1.236 of this ongoing corrective decline since 26th of February high. And 6,336, look back in time, is also the minor swing low area of 22nd of August and 3rd of September last year. All right, so still maintaining that bearish buyer's view. Only a breakdown below 6,442, I would tighten my pivotal resistance level. I will tighten my pivotal resistance level from 6,648 to 6,550 on the SPX 500. Okay, next up and lastly will be the Nasdaq 100. So the Nasdaq 100 came down, hit Monday swing low before staging some kind of sideways movement over here, 23,645. All right, so given that it hasn't broken below Monday swing low, I do not want to tighten my pivotal resistance, because it can be considered trapping in this 3-day or 4-day plus of range movement, going back up towards the top of the range again. So with that, slightly adjusted the pivotal resistance level to take into account of very clearly this bunch of rejection here since 24th of March, which is since this Tuesday, at 24,338. So adjusted slightly lower, 24,338. That will be my adjusted short-term pivotal resistance level. Breaking below 23,645, maintaining that bearish buyer's view to expose 23,506, 23,400, followed by 23,150, which is the 1.382 FIBO extension of this ongoing corrective decline since the high of 26th of February, and 23,150 if you go back in time. That was also a graphical swing low area or congestion area of 3rd of September. Okay, go back over here. Okay, only a bullish breakout above 24,338 that would invalidate today's bearish buyer's view to see a squeeze up to revisit this Monday's swing high at 24,550, which corresponds with the 20-day moving average. Breaking above 24,550 will see the extension of this mean reversion rebound rally, testing the next intermediate resistance at 24,787. All right, so that will be the Nasdaq 100, only breaking below 23,645. Then I will tighten the pivotal resistance to 24,046. All right, so still maintaining that bearish buyer's view on the Nasdaq 100. Next up, commodities market, starting with the gold XAU/USD. So gold XAU/USD slide down as expected, indicating that whatever bounce that we see from Monday is a corrective rally. So with that, I would now adjust my pivotal resistance level to 4,620. So that will be my short-term pivotal resistance level, very close to this week Wednesday high. Intermediate resistance level will be at 4,486, where it got rejected yesterday during the start of the US session. But so far, price action has been holding above a key near-term support level, which has been formed on this Tuesday low during the Asia session at 4,319. All right, over here. So breaking below 4,319 will expose the 200-day moving average again, which is the swing low area of 4,167, 4,099. Below 4,099, which is the low of this Monday, will potentially expose the 18th of November 2000 minor swing low at 4,007 over here. So if price action breaks down below 4,319 thereafter, I would tighten my short-term pivotal resistance to 4,486 for a better risk reward perspective. However, if price action don't move down as intended and starts to do a breakout above 4,620, then potentially the corrective rebound sequence may extend further to test or challenge our medium-term pivotal resistance for this week at 4,736, 4,775, which correspond with the descending trend line from 12th of May. And formerly, previously, this swing low area here now turns into a pullback resistance level at 4,736, 4,775. So that's for Gold XAU/USD, still having a bearish bias outlook for today on the intraday basis, using 4,620 adjusted short-term pivotal resistance to maintain this bearish bias view. Lastly will be the West Texas Oil. So before I jump into the West Texas Oil intraday chart, let's take a look at the longer time frame chart, which is the daily time frame chart. So the daily time frame chart, we start to see that after that sell-off this Monday, where Trump claimed that some form of negotiation process is going on between US and Iranian stakeholder, the market sold off. And ever since then, in between, Trump continues to claim that talks are going well. However, the West Texas crude oil doesn't price in such scenario and continues to bounce up higher, holding firmly above this 20-day moving average. So indicating that the uptrend still remains intact for West Texas crude oil over here. So if you look at from a micro perspective, minor time frame perspective, pardon me, which is the 1 hour chart of the West Texas oil, it continues to trade above yesterday's broken out 93.70 level. So this is the 93.70 level. Previously, there's a rejection on Wednesday. Yesterday, it did a bullish breakout. And in today's early Asia session, 4 a.m. Singapore time, where Trump's decided to make another news flow stating that all things are going well between the negotiation process. And he also decided to extend that deadline where by 10 days, where US could potentially strike Iranian oil and gas facility. So the deadline was extended from 5 to 10 days, but the West Texas crude oil market doesn't seem to be pricing in such optimistic news, and the sell-off initially was being brought back up. And if you look at today, currently price movement right now at 11:49 a.m. Singapore time, it continues to hold pretty much firmly at 93.70. So with that, because I don't want to tighten it to 93.70 in terms of the short-term pivotal support level, just in case of any wild whipsaw. So short-term pivotal support will still be at around the 20-day moving average at 88.36, 85.50. All right, unless price action has a bullish breakout and hourly close above this minor range stop that has been in place since last Friday, which is 102.25, then I would tighten my short-term pivotal support to 93.70. So overall, still maintaining that intraday bullish outlook on West Texas crude oil, using for now 88.36, 85.50 short-term pivotal support level, short-term pivotal support zone. Breaking above 102.25, then I will tighten it to the short-term pivotal support to 93.70. After 102.25 may potentially visit 111.28, and even as well as the current 4-year high that was printed on 9th of March at 1116.56, 1119.54. Right, only a bearish breakdown below 85.50 will invalidate today's bullish bias view to see a corrective slide to expose the next near-term support level at 81.85, followed by 77.26/76.83. Right, so that sum up all the intraday technical outlook on the broad-based cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for / events to look out for today? So today will be a rather quiet session. So at the start of, in terms of economic data over here, so for the start of the European session at London time, London opening hours, 3 p.m. Singapore time, we have UK retail sales coming up. So that will influence the sterling dollar and the sterling dollar and sterling crosses. So retail sales year on year for February, market participants expecting a weak number, 2.1 3.1% year-on-year, down from 4.5% previously printed in January. And we continue to see a slew of ECB officials speaking. ECB Kelvin at 3:45 p.m. at ECB Montagna at 3:45 p.m. as well. All right. And going forward down the calendar at 10 p.m. Singapore time, we have the finalized figure of the University of Michigan consumer sentiment. And this consumer sentiment previously was at 54. So very unlikely there will be a big change in terms of the finalized figure. So that could be a non-moving impact on the major US dollar pair and the major US stock indices. So that's it in terms of the key economic calendar data. So focus will be definitely for sure on the situation surrounding this Middle East scenario, where US/Iran war is not showing any signs of a very clear de-escalation, and market will be on the lookout for any signs of a build-up of US military troops in the Middle East that could potentially signal an imminent ground invasion. That could some speculation that may take place over the weekend over here. So do pay close attention to the risk management perspective, because market may start to actually gap again when the Asia session resume early in next Monday. So with that, I hope that you guys have a much more restful weekend, given the current volatile movement in the market that we see in the last 3 to 4 weeks. And with that, I'm Kelvin here signing off, and we shall speak again on next Monday. Thank you.